Have you ever felt uncertain about passively investing in a syndication?
In today's episode, we're interviewing Bethany LaFlam. She is a syndication attorney with 20 years of experience. And here's what we're going to focus on. You, as a passive investor, what are the questions you must ask when vetting a sponsor and a deal? Don't miss this episode.
Welcome to the Investor Podcast. I'm Liz Fairclough.
And I am your co-host, Andressa Gadelli. So Bethany, a lot of investors that are coming from different industries, they want to leverage and invest in real estate, but passively, or a lot of real estate investors that want to diversify their portfolio and start passive investment. But here's what's missing. They don't have the skills, neither the tools to vet the sponsors, to vet the deals, and really feel confident about it. So this episode, we want to break it down for those investors, how to. So Bethany, when looking to invest in a deal, what are the steps to vet a sponsors? So if I'm on a call with them, what type of questions should I ask in order to decide if that is a good or bad sponsor to invest with?
The first thing is you're going to talk to the outward facing sponsor. There's usually one person who's out trying to raise money or that you know maybe, or how you found out about this deal. The first thing I'd ask is who else is working on this deal with you? Who else is making decisions on behalf of this deal with you? Are you the primary decision maker? What's your role? What's their role? I would also make sure it's not someone's role only to raise money and then they're not actively involved in the deal. That's a big no-no that we see a lot. And that's not allowed. And if they don't know that, we don't know where else they're not following rules or not, or where they're maybe cutting corners. So I would ask that question. I would do a good old Google search. I would dig deep into everybody that is associated with this deal, because as you alluded to, that's the most important thing of any deal is the team running it, because you can have a really good property with not a great operator, and it's not going to do as well as maybe kind of a mediocre property with an awesome team is going to actually probably perform better, just data-wise. So ask all the questions. And then if you come into asking questions of the operator where they get a little uncomfortable or you don't like how they're answering, or maybe they don't want to answer your questions, I would either walk away or keep digging. A really good operator wants to tell you all the things. They want to tell you all the information about this deal and their team because they're awesome. Right. And if they're not awesome or they don't know, then this may not be a good fit for you. You're going to want to get things like a feel for, are you comfortable with how they're answering? Are you comfortable with their investment strategy? Are you comfortable with their online persona? There are some angry people out there, right? That they present to you because they want money. And then you're like, ooh, I don't want to be dealt with like that if things go sideways. Right. Because sometimes tough things happen and you want to see how people behave when it's tough and not when everything is rosy. Especially right now, we're seeing some things are tough. Right. And so you see people's true colors come out when that happens. So ask all your questions, listen to your intuition. If you don't like the answer you're getting, either walk away or keep probing, but you get to have all the information. No one's going to think that you're stupid. No one's going to think that you don't know what you're talking about. Smart and wise investors ask a lot of questions.
Yeah, it's so true. I want to add something to the team part. Something that we've seen over the years with syndicating is that asking the operator what their team looks like, and are they full-time on the team? Are they part-time? Are they involved in other projects? Are they just solely on this team? Why that's so important is that sometimes you have people who are in acquisitions, right? And they're doing the underwriting, and maybe they're doing that for a variety of syndicators. So they get paid when what happens when the deal closes. That's when they get paid. So not that they're fudging numbers. I'm not saying that, but we have to really realize how people get paid and what is their, not in a manipulative way, but we often will move towards things when the closing happens, because that's when people like that get paid. So that's really important. I just want to share that little awareness that I've even had in syndicating for many, many years, just of recently, that tip that came up. So just know how the team looks from an underwriting perspective and also an operations perspective. Because to your point, Bethany, I also want to share, it's usually the front person who is often seen. And that's not necessarily the person running the day to day. And that's also piece. So tough questions. What have you seen is probably the most important tough question that gets asked?
What's the plan for operations? And the reason I say this lately is we see a lot of these education companies coming up. We see a lot of coaching programs, they're all centered around, most of them are centered around acquisitions and capital raising because that's sexy.
Yeah.
But that's not the business. That's just the precursor to the business. The business is operating the property. And so what I would want to know is that's wonderful that you found a great property. For a while, I mean, everybody was dripping with great properties, right? It's wonderful that you know how to raise the money. Yeah, you got to be able to do that. That's not the business, right? The business is how are you going to operate this property? What's your plan if things maybe don't go sideways? Are you relying just on, a cap rate that's going to manifest in a few years? Or do you have a plan for operations for cash flow? Like, tell me about how you operate and who's your operator and what have they done before? And I'm not saying you can never operate or invest with somebody when it's their first time, but look at the team around them supporting them to see if you feel good about how that's going to go. Are you comfortable with the business plan? Is the business plan sort of just like making a wish and blowing into the wind, or is it there's a real solid operational plan? And I cannot emphasize that enough because this is not an acquisition and capital raising business. This is a real estate operations business. I want to scream that from the rooftops when I see all these programs and like learn how to raise capital like it's its own business. It's not.
Yeah, it's dangerous.
Yeah, it is.
You're speaking my love language right now. That's my love language. I was like, yes. But here's the thing. Let's play devil's advocate, right? I am in a call with somebody and I'm asking about the operations, and it's very likely that the person is going to say, I will send you a PDF with the information or the PPM or whatever doc or the slide deck or whatever it is. And to me, I can read it, I can interpret things. But what I'm looking for in that call is like, how are they able to bring that plan to life? Verbalize it to me. Don't read it to me. Verbalize it to me. Paint the picture to me. Like really, like I need to get confidence in you explaining it to me. I think, correct me if I'm wrong, Bethany, if somebody say, yeah, you can look at the PDF for
That's
for
a red
that
flag.
piece.
I
Is that,
Yeah.
I think
I
so.
would
What do you think?
interpret that,
I'll be like,
but
beep.
Interesting.
it is for it, but I am very technical, so that would like red flag, right? I'm like, you're
Red
dead
flag
to
to me too.
You're dead to me. Is that to you too?
Yeah.
Bethany, what would you say?
Well, so even more than just sort of your gut and your operational experience from a legal perspective, if the person out raising the money does not have intimate knowledge of this deal, they might be there just to raise money, which is not allowed. And so I would say grill the person out raising money because they really should have intimate knowledge of what's supposed to happen. And they can say, well, I'm not the asset manager. Well, you're asking me for my money. I want to know what you're going to do with it. And if you don't know, I'm not sure why you're asking me for my money. So legally speaking, it could be problematic as well.
And there's nothing wrong with you saying, listen, I'd like to talk to the asset manager. I'd like to ask these questions to the asset manager. If they say, no, I'm the person, that's even another red flag, right? Because it's a team sport and no one's ever going to have every detail, but they shouldn't be shunning their team. That would be a huge red flag.
Yeah.
I love that. What are you seeing right now, Bethany, in terms of people vetting deals? I'm sorry, vetting operators in today's kind of economy? Because, there are a lot of great syndicators who might have a project or two that they're struggling with. That's not uncommon right now. I know that from multiple people. Good operator, not the best deal. So let's talk about how do you vet the operator knowing that a deal may not pan out to the business plan? What are any other questions that people could be asking today to make sure they're mitigating risk?
I would ask, are there any other properties that you're involved with that are having trouble right now? And see how they respond. Because you're right, a lot of people are having trouble. Doesn't mean they're a terrible operator. Doesn't mean you should never invest with them again. Sometimes stuff happens. Insurance rates went a little crazy. Mortgage rates went a little crazy. Who knows what it could have been. Seeing how they respond to that and how they're dealing with it might be the best diligence you could ever get versus, back a few years ago when every deal was making money if you just like took over a property, right? That doesn't really tell you a lot about operators because every deal was making money for a minute there. So I would say first, tell me about any difficulties you've had in a property. And if they've never had any difficulties, they're probably lying or they're nil, right? Because this is hard. It's a hard business. So how did you deal with that? What team members do you have around you that are going to help you deal with that if it happens again? Not did you ever have any, or have you only had perfect deals? We don't really care about that. Like in any business, you want someone who's kind of been through it, right? So they know how to get through it. You don't want somebody learning how to deal with difficulty on your dime necessarily.
That's right. Piggybacking on that, I want to talk about the full cycle, right? Because it sounds that with COVID, a lot of people are like, yeah, I am a syndicator. I became a syndicator. Now I'm raising money. And then you dig a little bit deeper and they didn't even complete a full cycle. And they are already teaching others how to syndicate, and they're in the middle of
Red flag.
Yeah.
Right.
So many programs. Yeah.
Right. All of that. But in terms of how important it is to understand the track record of the person. And when we say track record, I think people emphasize so much. Yeah, we just acquire a $30 million property, period. Well, tell me about all the other deals. So how can we evaluate somebody's track record, including performance, full cycle? What are the other non-negotiables in your point of view?
So I would dig deeper. If someone just tells you how much assets under management they have, or how many doors they have, or the metrics that people love to brag about, dig a little further. Did you lead those, or are you a 2% GP on those for whatever reason, whether you raised money or you did the underwriting or whatever? I mean, are all those doors under your control? And if they're not, that's fine. But I always tell people when I'm reviewing their business plans, because that's something that will help with because of this exact reason. There's a lot of puffing going on. And I'm like, we need to put a little disclaimer in there that says maybe you didn't lead that deal, or because it's misleading. And so anything that seems maybe too good to be true, just dig a little deeper in that. Or if you see a disclaimer that has some sort of caveat, dig a little deeper, because that's the lawyer telling you, hey, maybe there's something more here. We don't want it to be misleading. Ask more questions, right? And so I would dig deeper. AUM and number of doors, it doesn't really mean all that much, actually.
So as passive investors, we don't want to be active, but at the same time, we want to have enough knowledge and skills to evaluate the sponsor, the business plan, and the deal. So it's like a balance, right? You don't want to be super, super niched, but what is enough in your opinion when evaluating a deal?
So if it's your first time, I would suggest getting somebody who you know, like, and trust that has done this before, passively or actively, and just ask them to take a look at it. Take a look at the business plan. Talk to me about, what I've learned from interviewing the sponsors. Take a look at the PPM and the offering documents, and ask for advice until you're comfortable with it. It's a lot of information to digest, right? There's probably 100 pages of stuff to read, all this scary language, and maybe language that you haven't heard before if you haven't invested in these kinds of deals before. So ask your other people around you that you trust that's not a sponsor and say, hey, what do you think about this? And I'm not saying, because I know women hear this all the time, I'm not saying ask some dude in your life to make your investment decisions for you. That's not what I'm saying. I'm saying
thanks for the disclaimer.
Because I hear that a lot too. So I'm saying, though, just ask somebody else that you trust that's done this before and say, hey, this is what I'm thinking. I think it looks good, but I just want to make sure. Or, oh, this feels like maybe a little bit of a red flag. Is it me just being nervous, or is there something here? Ask the questions of the people around you. If you don't want to pay an attorney or a CPA or a financial advisor to do it, that's okay. Just ask a friend who's not involved in the deal or who's done passive deals before.
And the name of the game always is to mitigate risk. And so if that's one way to mitigate risk. And then you also, the person that you ask, or that, trusted community, that's why we built Invest Her. Have they been able to mitigate risk in the deals that they've had, versus just jumping into deals? So you want to go to someone who is a little more conservative. I would go to, even, because then they're able to say, okay, this is what I think, or this is what I, not to be like say no, 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 but if you're a yes, 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 it's good to have that no, no, no person that says, here's what I see. This is what I see. Right now, too, if people are not talking about, in my opinion, when you start asking questions to whether it's a community or a confidant, if they're not asking questions, well, what if this happens? Is that in the plan? What if that happens? Is there plan A?
You're talking about worst case scenario?
Worst case
what will
scenario.
happen worst case scenario?
If that's not in very, very clearly in the business plan, in my opinion, that is a flag. Because, that's a problem, meaning that they haven't thought about any sort of contingencies, especially right now. Right. So that's just a huge issue. My question, though, is that with regards to the paperwork, that paperwork that gets sent over is very overwhelming, and not every syndicator uses the same paperwork. It's all different, right? So what are the things that whether this is your first passive deal, this is your fourth passive deal, that you need to make sure that you look for? What are some of those red flags in the paperwork that as a passive you want to make sure you're calling out, or just being mindful of?
I love this question because I know it's a lot to read. I mean, we're talking, again, 75 to 100 pages, whatever. And I do recommend people read it. I do. However, I recognize that not everyone's going to do it. And some people are going to read it and go, okay, but it's like Greek to me. The couple things that I really want passive investors to look at, actually, and people skip over this a lot, is the definitions. Because lawyers will define complex terms, or terms that maybe are being used outside of their normal usage. Cash on cash is a good example of that. Sometimes we have to define cash on cash because people will use it in different ways. So look at the definitions for terms that are relating to your returns, for how the sponsor gets paid. That's really important. You want to read those definitions. Now, some of the definitions you can, are going to skip over, like what's a member mean and that kind of thing, right? But you want to look for fees, and you want to look for definition of like a preferred return, and a definition of however they're calculating your return. Is it AAR? Is it ARR? Is it IRR? What does that mean? Or how are you using it? Those kinds of things. So definitely don't skip over the definitions. Beyond that, I would look right to the waterfall section. How am I getting paid? Right? Am I getting a preferred return? And how are they defining preferred return? Because believe it or not, there are a million different ways that can be defined. And so we want to look and see how they're defining it. You want to look and see, when do I get paid in order of the sponsor? When do they start getting paid? How many fees are they taking, and for what? And what is it based on prior to me getting a preferred return? Because usually those fees will come out before any distributable cash, which means there is something going to the sponsor prior to a pref. Nothing wrong with that, but they got to tell you, right? And they also have to tell you, by the way, the sponsor has to tell you all the ways they're getting compensated relating to this deal, even if it's not a specific fee that you're in effect paying. Example, if I were a real estate broker and I was the one doing this deal, I've got to disclose that I'm getting a fee to broker this deal, for example. So all those things need to be disclosed to the investors. And it's important that you know all the ways. One is all the ways that they're getting paid before you, but two is all the ways they're incentivized to do a good job for you. Because I actually don't agree with when sponsors take nothing, because I want to know that my sponsor is motivated with me, right? And isn't just like, oh my God, I mean, I'm not going to make any money once I pay especially if things go sideways, right? Once I pay the investors, I'm not making any money. Now, don't get me wrong. I admire it when a sponsor's like, you know what, I'm going to take care of my investors no matter what. I admire that. I do. And I actually think it's sort of an obligation, even though not legally. But if there's no incentive, then I'm like, I don't know. I want to make sure there's a balance there, right? And then you want to make sure the last thing is you want to make sure that whatever is in that PPM matches what was in the business plan. Does that match your understanding of what they told you?
Oh, that's like, can we highlight that for a second? Because sometimes you have completely are we even talking about the same deal here or not? So when we're looking at, the business plan and the PPM and all the conversations, listen, English is not my first language, and I can make completely so many different types of interpretations of a sentence and so on, right? And at the beginning of my journey investing, I think I looked at lawyers and attorneys and anything like legality as oh, you only talk to them or have them when you are in trouble or need to solve something. And I can't fathom the possibility of looking at a PPM and a business plan and not having a legal counsel in my on my books, right? And the reason why I'm saying this, not to promote or do anything, but what is at stake when I sign that document and I don't fully comprehend? Because I am not an attorney, and I shouldn't. And that is, to me, it's a legal docs, like me trying to do heart surgery on myself just because I kind of read a book and know how to do that.
Me
So
too.
what have you seen when people decided to say, yeah, I'm good with this. I understand and I'm going to go and I'm not going to have a legal consult on it. Like I want horror stories, for
Okay, so
people.
let me kind of pull up a little higher level, and that is a PPM, a private placement memorandum, is a required document when you're accepting passive investors and selling securities. Okay, so that means if I'm selling securities, what does that mean? It means that I have accepted money from someone who expects to be totally passive, and they're relying on my efforts to generate a return for them. So now the SEC gets involved and says, okay, that's fine. But if you're not going to go register those securities, think Microsoft, Facebook, right? If you're not going to do that, you got to find an exemption to registering. A PPM is the answer to that. A PPM is all the risk disclosures that you're feeding to your investors to say, okay, I'm not going to register this offering publicly, but I got to tell you what's at risk if you're going to invest with me. Okay. A lot of people don't even understand that. So they think a PPM is sort of like a check the box, like, okay, I got a PPM off whatever online, right? It's not a check the box situation because if there's garbage in it, it doesn't satisfy the requirement of disclosure, right? So if you don't know what goes in it, it's not protecting you, right? A PPM actually protects the issuer, the sponsor, from being liable to the investor and to the SEC. So it's for you as an active investor to protect you. Now, for passive investors listening, it also protects you, though. That's the point of it. That's why the law exists, right? To protect you from somebody swindling you out of your hard-earned money, right? And so that's why it's important to read it, but it's important to have it. And the other part of it that you want to look at, which I missed a minute ago, which is the risk section. What are the risks of this specific investment? You know the risks of investing in a security, or you generally could know. That's in there. You know the risk of investing in real estate generally. That's in there. But what about this specific property? Is there a risk there? What's the risk of you not being able to hit your business plan? So when you're looking at all of that, if someone does a DIY offering document, they might not even know they're supposed to put that in there, what they're supposed to put in there if they're just using a template, right? And so that's where the legal professionals come in, and even the tax professionals can come in sometimes to come in and explain and ask the questions to draw that out of you so that you're all protected. So it's definitely not a check the box situation. It's garbage in and garbage out.
Yeah. I want to go back to really quickly the fees, because I think that's a really important one. Because not only is it telling you about the actual fees and what the team is getting paid, when you're getting paid, how you're getting paid, but it also is telling you are they approaching business in a fair and equitable way? And that matters to vet not just the deal, but the syndicator, because now you're doing business with these people, right? You are literally a partner in a deal. You're not lending money. You're a partner in a deal. So talk us through really quickly for those, just even if they've been in a deal or passively, or this is their first. Walk us through just quickly that you got the acquisition fee. I know a lot of the fees because we're active syndicators, but just walk us through the fees and what the fair and equitable range is. Because I think that's important for women to hear, because it could vary. I know there's not that many. So do you mind just sharing that?
Not at all. And it does vary depending on what the asset class is and all of that too, right?
Let's go with multifamily as an asset class.
So typically what we see, an acquisition fee is pretty standard, usually about 1% to 3%, depending on the size of the deal, right? More than that, and you just have to ask questions as to like, why is it more than that? And they might have a good answer, right? But you get to ask the questions. So more than like 1% to 3%, and just ask the question. Asset management fee is another one that's pretty standard. That's usually 1% to 2% of gross revenue. I do not like to see asset management fees that are based on the amount of capital raised. There are some exceptions to that if it's a fund and whatever, but even still, I would rather see it be either on the cash coming in because it's performance based, or at least on capital deployed and working for you versus money just sitting because I raised it. There's a couple of reasons for that. One is on the sponsor, and the other is we don't want it to look like we're paying people to raise capital.
Can we stop there for a second? Because would that be a red flag or is acceptable?
It could be. It just depends on the answer. It's just a question that you should ask as a passive investor of, hey, what's this based on? If it doesn't say in the definitions, which is where we put that, right? If it doesn't say what is the asset management fee based on, ask the question. And if it's based on capital raise. Well, what happens then if my money's sitting and not working? Are you taking a fee off? Am I just paying you? Right? If my money's sitting, then what? Right? So it's just questions to ask.
And asset management is all about managing the asset and managing to the business plan. So quite honestly, it should be tied to the performance, but I just want to insert that.
It sounds so obvious to me, like, right? But
well, so that's another good point. Sometimes I've seen in other documents, not ones that I've done, that say equity management fee or even sometimes capital raise fee. And no, that is a red flag. That is paying yourself to raise money to run your own business. That's just a thing to
That's really what the acquisition fee is for. The acquisition fee is there to kind of give a win, so to speak, to the folks who put the deal together, which is the money. And I hear you.
What am I hear this right? That people are like making up terminologies just to.
Yeah. And that's why we're going over this, because I think people are going to overlook it, right?
Right. Sometimes they don't know better. And I've seen them where, it's in there and it's, prepared by an attorney, but it's still in there. And so that's the first thing is like, hey, you can take the fees. You just have to explain very clearly why you're getting the fees. And it has to not be based on something that's illegal, obviously. Right. Well, I say obviously, maybe it's not obvious because I keep seeing it. Right. But another one that's pretty common is a loan guarantor fee. Totally reasonable to say, hey, I'm putting my own credit at risk here to guarantee this loan for everybody to make a bunch of money on. I want a fee for it. It's usually about 1%. A refinance or a disposition fee, we call it a capital transaction fee, but it means refinance or disposition. So you get a fee for doing the work to refi, usually 1%, or doing the work to sell, usually 1%. Those are the standard ones. Beyond that, we're getting a little creative. It doesn't mean it's bad. I know I have plenty of clients that have like fully integrated businesses. So they take fees because they're doing all the different aspects of it. So they have to disclose the fees for being operators in like deep vertical, right?
Construction management, those sort of things that make sense, right?
Fee, yes. Construction management development are if it's relevant, then those are pretty standard as well. Now I will say this, having all of the fees is not standard. Those are some pretty standard ones, but having all of them could turn an investor off because they're going to be like, okay, well, how am I supposed to get paid? But that said, that's where you look at the pro forma and then say, okay, the projections do bake in all these fees. They should take into account after the sponsor gets paid, we're still projecting whatever percent. And then the investor, if they're like, okay, well, I can live with that. I can live with the 17% annualized, even if you get all your fees. Super.
I love that, Bethany. I want to just drill something that we didn't get a chance to talk about that I think is really, really important too. In addition to the fees, right? In addition to these questions, vetting the operator, vetting the deal, you really want to press on how well are they at projecting rental growth? Because the whole name of the game in any of these projects is increasing.
What are you talking about?
I know,
people
right?
Are making mistakes with that.
I believe, and I think that if you put a point out there that so many folks are struggling right now because they projected rents at a point where they're not getting those rents and other variables, interest rates, and insurance and all the other things. It's coming to a perfect storm. So, you're not going to know rental growth in an area as a passive investor to the T. You're not supposed to. You're passively investing. But ask the question. How confident are you? Tell me a little bit about how you got to that rental growth. And if they don't have a comprehensive, conservative approach that has been well thought through, and they can back it up with the business plan, I would run very, very, because everyone's just pumping up rents and making these deals look like they're amazing, and they're not. So right. I just want to put that note in there in terms of vetting the deal. Bethany, I bet you we could just keep going here because this is like a whole, you're never going to know enough. You need to know enough to vet the deal and the operator. And that's what the purpose of today is. And it's a process. So, where can everyone listening learn more about you and the good work you're up to?
They can follow me on Instagram, Bethany_LaFlam, or they can always email me, Bethany@plglp.com.
Bethany, thank you so much for all the listeners. Listen, if you follow what Bethany it's asking you to do, I think you're part of the 1% because a lot of people are not doing that. And that is, it's not the whole picture, but it covers, it's a beginning, having the conversations. I keep hearing over and over again, Bethany, you saying, ask the question and see how they react. How that tells a lot. And that alone is really priceless. So thank you so much for being here and sharing all your knowledge. Thank you.
My pleasure. Thanks for having me.